What if I told you that the way you pay for your car, student loans, or mortgage could either boost your credit score or drag it all the way down? Welcome back to March Money Moves, elevating your credit in 30 days. I'm Sabriyah Callis, your partner in finding and funding your new home. Today is day 7, and we're unlocking the truth about installment loans, one of the biggest factors in your credit profile. So if you've ever financed a car, taken out a student loan, or paid a mortgage, then you've had an installment loan. But do you really know how these loans impact your credit score? Stick around because today we're breaking it all down. Let's get started. Let's begin with defining installment loans. So, installment loans, they are the loans where you borrow a fixed amount of money and repay it over a set period of time with scheduled payments. Now, these loans do have a start date and an end date and a fixed or variable interest rate. Unlike revolving credit, which we'll get into on tomorrow, where you can borrow repeatedly, like with credit cards, installment loans, they have a structured repayment schedule. So, common types of installment loans would be loans that you might already have in your arsenal. Auto loans, which is used to purchase a vehicle, typically repaid anywhere from 3 to 7 years. Then you might have a mortgage. These are long term loans that you might have on a home. This repaid over a 15 to 30-year period. Student loans, they're used to cover the expenses for education. The repayment terms on these are typically 10 plus years. Personal loans, that's the borrowed money for various personal expenses, usually repaid in 1 to 5 years. Then you might have a debt consolidation loan. This is used to combine multiple debts into one lower monthly payment. And since these loans have fixed payments, they can help build a positive payment history, which is the biggest factor in your credit score. Your installment loans affect your credit in several ways. First of all, payment history, which is 35% of your score, which is on time payments. They help boost your credit, while missed payments can drop your score significantly. Then they add to the credit mix, which makes up about 10% of your score. Lenders like to see a combination of installment loans and revolving credit, which is your credit cards. And having this good mix can help increase your credit score. Then the age. Older accounts, they help build strong credit history, keeping long-term loans in good standing can positively impact your credit profile. Then we have that debt to income ratio. It's not a score factor, but it is important to note because too many installment loans with high balances can make it harder to qualify for new credit. Unlike your credit cards, installment loans don't weigh as heavily on your credit utilization since they are a fixed repayment term. And like with anything else, there are pros and cons when it comes to installment loans. A few of the pros, they are fixed monthly payments, which makes budgeting so much easier. They also help diversify your credit mix, which helps improve your score over time. On time payments, they can help contribute to a positive credit history, and they can be used to consolidate high interest debt into low structured payment. Now, a few cons is if you miss payments, it can severely damage your credit score. Interest costs can add up, especially for long term loans. Taking on too many installment loans, they can limit your borrowing power for other financial goals. So please keep that in mind. Your action steps and best practices for managing installment loans are always paying them on time. Even one late payment, again, can drop your score significantly. I want you to consider automatic payments to stay on track. Second thing, pay more than the minimum. If possible, this can help reduce the interest costs and it can help pay off those loans so much faster. Thirdly, don't take on more than you can handle. I want you to be strategic about borrowing and make sure monthly payments actually fit your budget. Keep those older loans open if beneficial. Closing an old installment loan won't remove it from your credit history immediately, but a long positive history, it does help your score. So for installment loans, good or bad for your credit, the answer is going to be dependent on how you manage them. So when used responsibly, they can build credit, they can improve financial stability, and they can even save you money in interest. But if they mismanage, they can lead to debt traps and credit score damage. Comment below. Do you have an installment loan? How has it affected your credit score? Next up in March Money Moves series, we'll be talking about revolving credit, what it is, and how it affects your score. So don't miss out. Be sure to like, share this with someone that is on the journey to making money moves, and make sure to subscribe for more credit boosting information and tips. I look forward to seeing you on the next video. Bye now.